Hello everyone, let's do a quick review exercise covering the topics from Chapter 14, which are all the forms of long-term debt like mortgages, notes, and bonds. And in our first entry that we had to record, our company, Stats Management Incorporated, is signing a $175,000 15-year mortgage with a 7.5% interest rate, and they are doing so to acquire a building. They are apparently not making a down payment on this particular building they're acquiring. They're taking out a mortgage for the full $175,000. Well, the institution that they're getting the mortgage from has told them that if they take out this mortgage, their monthly payments are going to be $1,622.28. Well, let's start firstly by putting the mortgage on our books, and therefore also the asset that we are acquiring via that mortgage. So on April 1st, what are we getting? We are going to get a building, and this building that we are acquiring is costing us $175,000. So let's put the building on our books for $175,000. And we are acquiring that building by signing a mortgage, so we're going to also credit mortgage payable for that same $175,000. And what happened here is we acquired a building by signing a 15-year mortgage. In the next journal entry, we are asked to make our first monthly payment on the mortgage. Well, to figure out how much we're going to have to pay, we have to figure out how much of that $1,622.28 is going to go towards principal and how much is going to go towards interest. And the easiest way to do that is to prepare, as I have over here, a mortgage amortization table. So, on April 1st, we begin at the time of signing his mortgage with a balance of $175,000. Our first payment becomes due on May 1st. So let's go to May 1st. Since we ended April with a $175,000 balance, we're going to begin May with that same amount. And we know from the information that our total payment is going to be $1,622.28. Well, now we need to figure out what portion of that $1,622.28 is going to go towards principal and what portion is going to go towards interest. And we figure that out by starting with the interest expense. To find the interest expense, you take your amount owed at the beginning of the period, in this case $175,000. You multiply it by the rate of the loan, which is 7.5%, so I'm going to use 0.075. And then you multiply it by time. We are making a monthly payment, so 1 out of 12. And if we do that, we determine that the interest expense is $1,093.75. Well, our total payment is $1,622.28. And we know that $1,093.75 of that is going towards interest, which means the amount that is being applied towards principal therefore has to be the difference, which is $528.53. What are we going to owe on this mortgage at the end of the first month? Well, we're going to owe the difference between what we owed at the beginning of the period and the portion of our payments that went towards principal, so $175,000 minus $528.53, means that at the end of the period, after they make their first payment, Stats Management Incorporated is still going to owe $174,471.47 on their mortgage. When their next payment rolls around on June 1st, their beginning balance is going to be equal to their ending balance from the prior period, so we just bring down that $174,471.47. We also know that their total payment isn't going to change. This is a fixed payment schedule on the mortgage, like all of your mortgages will be in my class. So they're going to pay $1,622.28. Well, now we need to figure out what portion is going to go towards interest. And we do that with the same formula that we had before. We take our amount owed at the beginning of the period, $174,471.47. We multiply it by the stated rate of interest on the mortgage, which is 7.5%, so 0.075. And then this is a monthly payment, so we multiply that by 1/12. we come up with $1,090.45. And if our total payment is $1,622.28, but $1,090.45 of that is going towards interest, the remaining $531.83 is left over to go towards principal. And after we make our second payment, that $174,471.47 we owed on our mortgage is going to be reduced by the $531.83 of our payment that's going towards principal, bringing us to a new ending balance of $173,939.64. Moving on to July 1st. What you end one period with, you begin the next period with. So we're going to bring down that $173,939.64 is our new beginning balance for July. Our payment is never going to change. It is fixed, so that's also going to be $1,622.28. Our interest expense is now going to be equal to our beginning balance, which was $173,939.64 times our stated rate of 7.5% times 1/12, and $173,939.64 times 7.5% times 1/12 is going to come out to $1,087.12 of our payment going towards interest. And the amount that goes towards principal is what's left over from that $1,622.28 payment after the $1,087.12 payment or interest portion is accounted for, giving us a principal payment of $535.16. And our ending balance is just our beginning balance minus the portion of our payment that went towards principal. And that is going to be bringing us to an ending balance of $173,404.48. And through the magic of this program, I can just bring the fill handle down to fill the numbers in. One sec. And when I do that, the table should generate all the way through. And there we go. And we have their amortization table up through the month of October. And as you can see over here, each and every period, the amount that is going towards interest gets smaller and smaller by about $3 and change. The amount that goes towards principal keeps getting larger and larger, again by about $3 and some change. And overall, our ending balance is getting smaller and smaller as we go down because we're paying off a portion of our debt. This is a 15-year mortgage, and we're making monthly payments. 15 times 12 is 180 lines I would have to make for the full amortization table, which is way too much space to take up right now. But the concept holds true. So once you prepare this amortization table, your company will have it on its record somewhere. And if you need to record a payment on here, well, that's the best point of reference. And look what we have here. On May 1st, Stats Management Incorporated is making its first monthly payment on the mortgage. So on May 1st, what's happening here? Well, we're paying, as we see from our amortization table, $1,622.28 in total. $1,093.75 of that is going towards interest, and the other $528.53 is going towards principal. Well, the portion that goes towards principal is decreasing our ending balance. It's decreasing the amount we owe on our mortgage. Therefore, we should decrease in our journal entry mortgage payable by the amount of that payment that is going towards principal. So that $528.53 gets debited to mortgages payable. Next up, we have interest expense for the portion of our payment that is going towards interest. And our amortization table tells us that on May 1st, when we make our payment, our interest expense is going to be $1,093.75. And in total, if we sum those two numbers up, we're going to come up with a total of $1,622.28, which just so happens to be our total payment. Since it's our total payment, that is going to be the amount of cash which we are transferring to the company that we signed this mortgage through for the period. And that is the journal entry for Stats Management to record their monthly payment for the first month of the year. And here, what happened is we made May's mortgage payment. Next up, on June 1st, Stats Management is making their second monthly payment. So on June 1st, we can consult our amortization table just like we did before. We know a portion is going to go towards paying principal on our mortgage. So we're going to need another debit to mortgages payable. We know a portion of our June 1st payment is going to go towards interest, so we're going to need another debit to interest expense. And we know that in total, the amount that we pay is going to come out of our bank account, so we need to decrease cash. So the setup never changes for a mortgage payment. It's always a debit to mortgage payable, always a debit to interest expense, and always a credit to cash. What changes is the actual amounts that go towards principal, mortgage payable, and interest. And according to our amortization table, if I scroll back up just a little bit here, the amount that is going towards principal for the month of June is $531.83. The amount that is going towards interest is $1,090.45. So let's go and bring those numbers in here. We have $531.83 going towards principal. That's what we're going to debit mortgages payable for. We have $1,090.45 going towards interest. That's what we're going to debit interest expense for. And the sum of those two numbers together is $1,622.28, which conveniently happens to be the amount of our total payment. And here we made June's mortgage payment. Let's move on to another entry. On July 1st, Stats Management Incorporated is signing a $48,000 8% 4-year notes payable. And Stats Management, to pay this off, is going to make quarterly payments of $3,000 plus interest to pay off their debt. So what is happening on July 1st when we sign this note? Well, we're not required to make a payment yet because we're just getting the money right now that we're borrowing. So we start by debiting cash for the amount that we are signing the note for. And this is a $48,000 note, so we are going to debit cash for $48,000. Next up, we have a debit or credit, to notes payable for the amount that we are borrowing, establishing that liability on our books. So we got a credit to notes payable for $48,000. And here, what happened is we signed a 4-year note payable. On October 1st, we're going to have to make our first quarterly payment. Again, the terms of this note say that we are going to make quarterly payments every 3 months of $3,000 plus interest. Well, how much is interest going to be? Well, easy enough. We can go through and we can start a note amortization table so we have those numbers for reference. We took this out on July 1st, and at the time that we signed this note, the amount that we owed this lending institution was going to be $48,000. We're making our first payment on October 1st. Well, on October 1st, when we're making our first payment, our beginning balance is going to be equal to our ending balance before we made this, so that's going to be $48,000. We know, in this case, that the portion that goes towards principal is fixed. Each one of our quarterly payments is a payment of $3,000 that goes towards principal. What's going to change is the amount of interest we have to pay each time, and we find it by taking the beginning balance that we had, multiplying it by the rate. This is an 8% note, and multiplying it by times. This is quarterly payments. That's every 3 months, so we're going to multiply it by 3/12. And when we do that, we are going to come up with $960. We have to pay $960 in interest in addition to the $3,000 that we're putting towards principal. So our total payment in this instance is going to be $3,960. What are we going to owe at the end of October after we made this payment? Well, it's going to be the beginning balance minus the portion of our payment which is going towards principal. We owed $48,000, but we paid $3,000 of that principal off, so now we are indebted to this company that we signed the note through for $45,000. If we got to make a payment every 3 months, that means that our next payment after October 1st is going to be due on January 1st. And on January 1st, our balance at the time will have been $45,000. our principal payment. Again, this is a fixed amount of payment going towards principal. So again, is going to be $3,000. And to figure out our interest, we take our balance at the time we're making the payment of $45,000, multiply it by the stated rate of interest, which is still 8%, and multiply that by time. And this is a quarterly payment, so by 3/12, and that's going to come out to be $900. And if we're paying $3,000 towards principal and $900 towards interest, then our total payment is going to be $3,900. Our ending balance is therefore going to be equal to our beginning balance minus the portion going towards principal. We owed $45,000. We just paid off another $3,000 of principal. Now our debt's down to $42,000. If we made a payment on January 1st in their quarterly payments, we know another one 3 months later, which means that payment is going to be on April 1st. And on April 1st, we will have owed $42,000, our ending balance from the prior period. Again, we're making a $3,000 payment towards principal each and every payment. What changes is the amount of interest. So we take the amount we owed at the time we're making the payment, $42,000, multiply it by the stated rate of 0.08, and multiply that by 3/12. And when we do that, we come up with $840, which is going to make our total payment for our April 1st payment equal to $3,840. Our ending balance is going to be the $42,000 that we owed minus the $3,000 in principal payment, bringing our balance down to $3,900. And then from there on out, I can just fill in the numbers for you guys real fast. And when I do that, it will finish out our amortization table. And there we go. Through the following January, we see that each and every period, our principal payment is going to be $3,000, but our interest expense keeps dropping by $60 each time because the amount that we owe debt on is always going to be $3,000 lower with each payment. And our total payments are going to keep getting smaller and smaller. This is a descending payment schedule. If I went through and I did this for each quarterly payment for the next 4 years, I would get to a point where our ending balance is zero, but again, that's going to be a whole lot of lines. The reason we're doing it in this example is just so we have information on how to fill in our journal entry. So let's go back to what we started here, that on October 1st, we're making our first quarterly payment on this notes payable. Well, our information tells us that we are paying $3,000 towards principal and $960 towards interest. Well, that amount that goes towards principal is decreasing the balance of our note, which means we need to decrease the balance of the note on our books by debiting notes payable. And we're going to debit that for the portion of our very first payment that went towards principal, and our information tells us that's $3,000. And we had a portion of that payment that is going towards interest. Well, we're going to record that as an interest expense. So we'll debit interest expense for the $960 that's going towards interest in our very first payment. And then our total payment is $3,960, which has to be our credit. Well, what are we paying this institution with? We're paying them in cash. So we credit to cash for that $3,960 when we made the October payment on notes payable. Moving on down to our next journal entry, we see that Stats Management Incorporated is going to make its second quarterly payment on this note. So on January 1st, when we make our second payment, we still have a portion of our payment that is going towards principal. It's going to lower notes payable. We still have a portion of our payment that's going towards interest. We're going to have to record an interest expense. And we know that our total payment is going to decrease our cash balance of our bank account by that amount that we are transferring. So the setup every time that you make a payment on a note is exactly the same. It's always going to start with a debit to notes payable, followed by a debit to interest expense, followed lastly by a credit to cash. The three accounts are always the same and in the same place. What changes is a few of your numbers. So in our second payment on January 1st up here, $3,000 was going towards principal. That's the amount we're going to decrease notes payable by, $3,000. In that January 1st payment, we see that our interest expense is $900 that we are paying. So we're going to debit interest expense for that $900. And our total payment, the amount of cash that we are transferring out according to our amortization table for this January 1st payment, is $3,900. So let's go and credit that for $3,900. And here we have the fact that we made the January payment on notes payable. Moving on, we have another type of debt we have to account for, which is Stats Management issuing $50,000 worth of $100 face value, 4.5% 10-year bonds, and issuing those bonds, make this a little bit bigger, at a price of 92. These bonds are going to pay interest quarterly. So on February 1st, we are going to account for the fact that we are issuing these bonds to potential investors and receiving cash by selling our debt. Well, we're getting cash. So let's go and debit cash. How do we figure out how much cash we're receiving? Well, to do that, in this instance, what you're going to do is you're going to take the face value of the bonds and you're going to multiply them by the bond price. Always remembering that bond price is expressed as a percentage. So these bonds have a $50,000 face value. We can multiply that by the bond price of 92% or 0.92 and determine that we are receiving $46,000 in cash. Well, I'm going to skip a line right now. We know that bonds payable always goes on the books at the time of issuance for its face value, which means we're putting bonds payable on the books for $50,000 because we know we're going to have to pay back that $50,000 face value after 10 years when these bonds mature, which means we are issuing those bonds for less than face value. How much less? Well, $4,000 less. And since we need a debit to make our debits equal our credits, we know we need a debit of $4,000. What does that go to? It goes to our contra liability account, discount on bonds payable, because we are issuing these bonds at a price below their stated face value. We issued bonds at a discount. Going down to May 1st over here, we are going to make our first quarterly payment of interest on these bonds payable. And any amortization or any discounted premium we have is going to be amortized using that straight line method. So here we know firstly that we're going to have to record an interest expense. For how much? Let's figure that out and go back to that in a second. Next, we should take the amortized portion of this discount on bonds payable off of our books. And to figure out how much of that discount you're going to amortize, you should take your original amount of discount and then divide it by the number of payments in the life of this bond. So our original amount of our discount up here was $4,000. Let's divide that by how many times this bond is going to pay interest over its life. Well, how many years is the bond for? It is a 10-year bond. Okay. How often does this bond pay interest? This bond pays interest quarterly, which means every 3 months or 4 times a year. So if it pays interest 4 times a year for 10 years, over the life of this bond, it's going to pay interest 40 times. And therefore, we have a credit to discount on bonds payable of 100. I put that on the wrong side. Sorry about that. Let's do that one more time. The original amount of discount was $4,000, paying 40 times. There we go. $100 credit to discount on bonds payable. Next up, we have a credit to cash for the actual amount of interest that we are paying, which you can find by taking face times rate times time. So what is the face value of these bonds that we are paying interest on? These bonds, as we see in our February 1st entry, have a face value of $50,000. The stated rate is 4.5%, so 0.045 in decimal form. In time, this is a quarterly payment, which means that 4.5% is for the year, but since it's quarterly, we're only going to pay a quarter of that. Let's multiply by the portion of time that's going to pass until we have to make our next payment, which is going to be next 3 months, so 3 out of 12. And when we multiply that out, we come out with $562.50. That is the amount of cash that we are going to pay in interest payments to our bond holders. We also get to record interest expense equal to the amount of discount that we amortized. So in total, the amount of interest expense that we get is now equal to the sum of our two credits, which is $662.50. What happened here is we paid quarterly bond interest. And then lastly, on August 1st, Status Management Incorporated is going to make its second quarterly payment on its bonds payable. Okay. What are we going to need? Well, we're still going to record an interest expense. We are paying interest, so we know we're going to need a debit to interest expense. Every time that we pay interest, we're going to amortize a portion of that discount using the straight line method. So we know we're going to need a credit to discount bonds payable. And we know that we're actually handing over cash to our bondholders, so we're going to need a credit to cash. So just like our other forms of debt, the setup of this account doesn't change. Every time you pay interest on a bond which is being carried on your books at a discount, you're always going to have a debit to interest expense and two credits, one to discount on bonds payable and one to cash. Well, how much, let's skip interest expense right now, how much is the discount going to be amortized for? Well, up here, we found it was the original amount of the discount times the number of payments. The original amount of our discount, way back to our February 1st entry, was $4,000. And we already determined on May 1st that the total number of payments we're going to have is 10 years of quarterly payments, or 40 in total. So if we take that $4,000 and divide it by 40, we get a credit to discount on bonds payable for 100. And it should be the same, because under the straight line amortization method, you are decreasing that discount by the same exact amount periodically over the entirety of the bond's life, so it's spread out evenly and it disappears at the end. What about cash, the actual amount of interest we're going to pay? Well, that is face times rate times time. So what is the face value of our bond? We see on our February 1st entry, it tells us there was $50,000. What's the rate? That hasn't changed. This bond was still issued at a rate of 4.5%. So let's multiply that 50,000 by 0.045. And what is time? Well, we're still making a quarterly payment on our bond. So that's 3/12. And when we multiply that out, we come up with $562.50, which means since we get to record interest expense equal to not only the actual amount of cash that we transfer for our interest payment, but also the amount of discount that we amortize, we're going to come up with a debit to interest expense for $662.50 when we paid quarterly bond interest. And you may notice this journal entry is exactly to a T the same as the one that we recorded on May 1st. And that should be true. If you are making payments on a bond and you are using straight line amortization to remove any discount or premium from that bond, your journal entry is going to be exactly the same each and every time you pay interest. Why is that? Because none of your inputs change. The original amount of the discount never changes. It's the original amount of the discount. The number of times you're going to pay interest over the bond's life, that doesn't ever change. You know that from day one, how many interest payments it's going to take to get you to that maturity date. The face value of the bond never changes because we never make a payment towards principal during the bond's life. We just pay for interest. Therefore, we're always carrying that debt on our books at its face value. The rate is stated and it does not change. It's always going to be exactly the same. In time, you're making a payment every 3 months, quarterly payments, for the entirety of the bond's life. So none of your inputs change in the calculations. Once you have figured out the payment of interest and the amortization of a discount or premium for your very first entry, it's going to be exactly the same for a bond every single time going through.